Okay, so in past episodes, we've been talking about the Dow Theory, that is great, but then comes the question. We are humans, and humans strive for betterment, to do even better, to push the envelope. So can we do even better? Is there any kind of Dow Theory can the Dow Theory be improved? The answer is yes. And this is not a theoretical proposition. The Dow Theory was improved already almost 25 years ago by Jack Shannet, the man I show in this photo, my mentor, our editor emeritus in our newsletter. For me, is really one of the best Dow theorists ever. As simple as that. For me, is maybe the best Dow theorist ever. Is a genius. I was very lucky to be mentored by him. He published the book, The Dow Theory for the 21st Century, I think it was in 2007. And when I read this book, for me, it really was mind-blowing. I said, wow, suddenly all the pieces of the puzzle, they fell into place. And then suddenly investing was made easy for me. I don't say that the book is easy, but once I understood the book, which is basically the improvements he made on the Dow Theory, which he calls the Dow Theory for the 21st century, I said, wow, this is the thing. I also realized that this book was written by a man with hands-on experience and a man that was making real money. Then I decided to subscribe to his newsletter because he had a newsletter, because I said, well, I don't want to miss. I want to read each month how he applies the Dow Theory. I understood his book, but I want to see in real time how he was applying his methods, and it really worked. And this is also very important. The Dow Theory was, for the 21st century, was discovered by Jack Shannet some 25 years ago, but he has been trading this in his newsletter. And then 2.5 years ago, I became the editor of this letter because I was, well, maybe he considered me that I was good enough to continue with his letter when he became the editor emeritus. And it's been tested under fire. So it's not a theoretical proposition. Okay, yes, the theory can be improved. No, it has been improved. There is the book that proves it, but it's been traded with real portfolios in real life, and all subscribers can see it because we have all the past letters in our server. So okay. So, okay, if the Dow Theory for the 21st century is so good, what makes the Dow Theory for the 21st century an even better performer? So, in other episodes, I explain what makes the Dow Theory a better trend following system than moving average, breakout system. So, okay, so what makes the Dow Theory an even better performer than the classical Dow Theory? Okay, first off, there is more outperformance versus buy and hold. So we make more money. Secondly, there is further drawdown reduction. So the drawdown gets reduced even more than with the classical Dow theory. So the more you outperform and the more you reduce your drawdown, the more money you make. And it's proven and it's actionable. So it's not theoretical. So this was created by a man that was making money in the markets, and it's been traded in real life for almost 25 years. So we are not theoretical guys. I told you my origins. I was a lawyer. I wanted to make money, so I'm not for theories. I'm for the Dow theory, but not for theoretical things. I want things that work. Okay. What I said is nice and dandy. The Dow theory is great. The Dow theory for the 21st century is even greater. But let's measure our performance. Okay, the proof of the cake is in the eating. So this slide is a very important one. It shows you the Dow theory for the 21st century applied on the Dow Industrials from 1953 to 2023 versus buy and hold. So one thing that pisses me off when I see sometimes people in the markets is that they take very short samples. From 2018 until now, it worked great. I'm sorry, but this is not enough, a large sample. You need a larger sample. So our Dow theory has been tested and basically traded since 1953. So this is a reasonably long is a long track record. So you can see that if we started with $1, so it took one, I indexed it to one, both for buy and hold, the Dow Industrials buy and hold, and also the Dow Industrials, but applied with the Dow Theory, applying the Dow Theory to the Dow Industrials, we see that the Dow Theory multiplied 7,469 times the initial investment. So $1 became $7,469, whereas buy and hold only increased, well, it was increased by total return. By the way, these are total including dividends. This is total return figures. So the Dow Theory, the buy and hold all increased, well, 1,268 times, which is okay, it's nice, but we did a much better job at outperforming with the Dow Theory. Okay, that's nice, but there is another measure of the beauty of a trend following system, and this is drawdown reduction. So this next slide shows us how the Dow Theory for the 21st century does during difficult times. In tough times, how do we do? So I single out what has been one of the worst periods for the stock market. So it goes from 1999, you can see on the bottom chart, from the end of 1999 to the end of 2009. So this chart shows 10 years with two huge bear markets. We had the 2002 bear market, and then when we were more or less, well, I'm going to break even, then comes 2008, and an even worse bear market. So I think this stressful time period is good to show how the Dow Theory, and also even better, the Dow Theory for the 21st century fares during difficult times. The chart is based on year-end data, so value of December 2002, 2003, etc. So you can see that in the year 2000, if we measure the Dow Theory on a year-end basis, we had no drawdown. So in 2001 and 2, we actually went up, whereas the Dow Industrials was going down, as you can see, from 2000 until 2002. The Dow Industrials was going down, whereas the Dow Theory for the 21st century even managed to go up during a bear market. Capitulation has a lot to do with that. This comes in a later episode. Okay, so you can see, okay, then we survived the bear market. The Dow Theory survived by making money, so we didn't lose money in that bear market. We continue, and then comes, you see the red ellipse, the bear market in 2008. And there, the Dow Theory, we lose a little bit of money because it was really a huge bear market. The S&P went down by 55%. But if you compare, in 2008, the Dow Theory had a much smaller drawdown than buy and hold. If you look, the Dow Theory started, the bear market, when the bear market started, the Dow Theory was at a level of $2. So once again, I started with $1 in December 1999. You can see here, $1. And on 2008, the Dow Theory was at $2. So we had doubled. Look at buy and hold did not even manage to reach 1.50. So when the bear market starts, the Dow Theory had greatly outperformed buy and hold. But now what comes next is what's important. The Dow Theory went down, but really, look, more or less it went down to 1.70. So this is really a very muted drawdown. It's more or less 15% decline, whereas buy and hold, as you can see, had on a year-end basis a drawdown, I think it was exceeding 35%. So it's much. And of course, the end result is that after the 10-year period, when the 10-year period ends on December 2009, the Dow Theory for the 21st century was once again making all-time highs, whereas buy and hold, the orange line, remains well below the previous peak and almost at the same level than on December 1999. Remember that in December 1999, we were at 1, and when we finished the period, we are more or less at 1.1. So including dividends. So I think this chart epitomizes, shows that in really difficult times is when we do better, because furthermore, we need drones to succeed. So we need the stock market to go down to really succeed. But I think this is really gives a very important image that the Dow theory for the 21st century really works.